Let's go now to our friend Bimnet Abibi from Galaxy Trading. As always, Bimnet, great.
Thanks for having me.
So we've had a little bit of a recovery. You can see over my shoulder here on the block clock from, I guess, a little bit in doldrums, but again, still in the channel. Bitcoin volatility has been like almost at historic lows.
Yep.
It seems like, I mean, I haven't seen a lot of data. What's going on in the markets these days?
I think in crypto, it's just been sort of like a malaise, just as a function of an absence of catalysts, right? You know, we had the Ripple stuff a couple weeks ago, those court cases.
Yeah.
But
ETF stuff was now at this point like almost 2 months ago.
Correct. And so it just kind of feels like a waiting game in crypto. And then, you know, risk markets, you know, more broadly, haven't fared too poorly or too great, to be honest with you. S&P's down, you know, almost 1% today. And, you know, we've had a couple large tech names that have really underperformed. But it doesn't seem like we're on the precipice of like, you know, a big sell-off or anything like that. The real story, you know, that is at least attracted my interest a lot is on the fixed income side.
That's what you said last week. You gave us some of the stuff about the long end of the curve.
So the long end of the curve, you know, we've sustained above 4% on the 30-year for a little bit now. I think 30-year yields are hovering around like 4.18 right now.
So can you break down, just for our audience, what that really tells you, right? I mean, we're talking about long dated issuance, right?
Yes.
So long-term bond, 30-year bonds.
30-year bonds.
Right? Like that's buying U.S. debt that doesn't mature for 30 years, right?
Correct.
So theoretically, if you're very bullish on like long-term U.S. debt, having debt, paying its debt, being a good economy in 30 years, et cetera, right? You could hold that for a long time. You would feel that.
Well,
But so people, when the rates go up, it means there's less demand for it. What exactly is what is this telling you? Is there any, is it a comment? Is it purely
it's
structural?
a combination of
or
a
is
lot
it
of
a comment
things.
on the United States' 30-year prospects? I mean,
Well, I would just treat it as a market like anything else, right? It's just another asset. And so, you know, what moves an asset? It's like buyers and sellers. And I'd tell you that there's an absence of buyers right now, and it's pretty meaningful. And there's an absence of buyers, one, because central banks are pulling back and actually tightening their balance sheets rather than expanding them.
so they're buying less of it.
Yes,
Right.
correct.
Right.
And they're big buyers.
Yeah.
And, you know, I think foreign appetite has waned a little bit as well, just because foreign central banks are doing the same thing. In addition, just functionally, the front end has gotten more attractive on a relative basis because, you know, we've jacked up front
Rates
end
are
interest
higher.
rates.
Yeah.
And you don't have to take duration risk
Right.
there. And so, and then, you know, I think another element of it is also just uncertainty around inflation, right? Like going out 30 years, there's a high degree of variability to fixed income and inflation expectations and where inflation realizes over that time. And so, you know, you require a higher term premium
Right.
in theory. And so I think the market is just repricing that part of the curve in the context of inflation, which I mean, could really start going back up again. I mean, so the big story this week is you've got CPI on Thursday.
Right.
Right. And headline CPI is expected to come in the low 3s, and core CPI is expected to come in mid to high 4s. Right. But when you look at things like energy markets, right, crude just topped $84 a barrel. Like nat gas has started to pop off, in Europe,
Right.
you know, as one example. And so there are clearly upside risks to inflation still, particularly in the context of a labor market that's just so tight at 3.5% unemployment.
I was showing this. I said this to somebody, and I was explaining what I think is a pretty wide consensus that you've articulated plenty, which is that unemployment is good. Like CPI's come down, of course, and go back up, but like the idea that the soft landing is possible. Right. And even probably the more likely of the scenario when you look at everything right now. And they were like, yeah, but like you can't use unemployment because like if you look at actual numbers of people searching for jobs, it's worse. And I'm like, so I did that. It's not worse. The labor force participation rate on balance is lower than it has been in a long time.
Pre-COVID,
But if you take out the elderly,
Yeah.
if you look at 25 to 54s, it's near all-time highs.
Yeah, that participation.
So people are working. I mean, it's
people are working.
Yeah.
And the problem is the wages are keeping up, or that there's wage
Right. So they're
pressure.
working and they're making more money.
Correct.
Wages are going up too.
Yeah.
Yeah. It's just it is interesting.
And
though.
unless you have that like come off in some way, like it's going to be tough to tackle inflation.
Right.
And my other point to that is like, stocks have come off a little bit, but who's really going to lay off like 10% of their workforce if their stock price is like close
down a couple percent, yeah.
or like super close to all-time highs.
Right. I mean, like even like we were talking about there were some big tech names. And equities. Like last Friday was a pretty big sell-off, right?
Yeah.
But it's sell off from like all-time high.
Yeah.
So
it's like
down a couple percent.
Yeah.
From all-time high. Yeah.
Right. And
you need more sustained reductions there too.
Right.
And the fear is that if you ever looked at the interest rate chart or the inflation from like the 70s and 80s when Paul Volcker was at the Fed, like they raised them and it came down a little bit and then they thought they were done and then it like spiked back. There were multiple attempts at curbing inflation back then, and that's obviously what the Fed is very weary of and doesn't want to have to do. That's why they're remaining hawkish, right?
Correct. Higher for longer is how they're putting it. And, functionally, there are things that mean that the inflation number is going to continue to have upside risks because you're losing like really low numbers from a year ago now.
Right.
And so you're getting, the opposite of base effect. Some base effects, basically.
Right.
And so, it makes things very tricky. But I think ultimately, like what the Fed's, left in terms of decisions is, they basically have to stay higher for longer. And the question is like how high?
Yeah.
Right. And so do they hike rates one more time or do they pause?
Feels like they do, right? Or maybe I
think they should.
Well, they hiked
they
last
could justify
time, so
it.
what? Maybe they pause again and then hike again?
I mean, the way I think about it is like, what are you really risking? Right.
You can always swoop in and cut. Like,
yeah. Like, why wouldn't you if you're genuinely still worried? And I personally, I'm like, some of these valuations in equities are just still absurd.
They still seem high.
Still absurd. And like some of the valuations in like privates, still crazy. Nobody's really selling their homes. Like home prices have been fine. Where you're seeing weaknesses in things like, used autos, which it's okay.
It's not It's not like the core of the economy. It matters.
Yeah,
but
it matters, but it's not, it's not the end all if like cars get cheaper.
Right.
And so, I think it's a really weird spot. And the way I think about things is like really, okay, so let's say we're in this kind of economy for the next couple of years. Are terminal rates properly priced? And so the way I think about terminal rates is like, the end state of like what neutral is, for the Fed funds rate. And right now, market-based expectations have that around 3.3%. So that's a 200 basis point cut from like peak terminal rates.
Mm-hmm.
And so, I still struggle with that idea because the U.S. economy looks like it is functioning just fine with 5% interest rates. And like, I know we've got these student loan things, coming, et cetera, but I think there's a very feasible scenario where it's like 5% interest rates are just normal. They don't cause anything to like blow up at all.
Which it makes sense. You hear, it's like you had to walk uphill both ways to school when I was a kid. But I hear the same, like, oh, we had to pay like 12, 13%, depending on when your parents or whoever's saying this hypothetical thing to you. They've been high. They've been high in the past, and the economy has functioned.
Yeah.
We just became very used to very low.
I think particularly in the U.S. where folks are just so sheltered from high interest rates with respect to having locked in a lot of fixed rate financing.
Yep.
Like the U.S. in particular can really handle higher for longer.
Right.
Super well.
Yep. All right. Well, we're gonna have to see what happens. It is a little bit of the doldrums of summer.
August for sure.
Yeah. But I know it's gonna be an exciting fall too. But in crypto and in markets.
Just give me an ETF. I'm not asking for much.
Our friend Bim Netabibi from Galaxy Trading, as always. Thanks for joining Galaxy Brains.
Pleasure.